Good morning, good afternoon, and welcome to the Quarles and Brady Business Law Training Session, Why Industrial Revenue Bonds Are an Attractive Financing Option. I am Kathleen Yu, a partner in the Business Law Group in Phoenix. Before we begin, we would like to invite you to join us next month on July 13th for a program on protecting your intellectual property. For CLE credit for our in-person guests, please make sure to sign the sign-in sheet located on the registration table. For our webinar guests, please fax or email the form located at the back of the PDF to Haley Musgrave, whose contact information is on the form. If you are on the webinar and have a question, please type your question into the question box on the upper right side of the screen and press send. We will make sure the speakers receive the message. Also, if you are on our webinar, we have muted all phone lines and you are in a listen-only mode. After the program, you will receive a survey for your feedback. Please be aware that this presentation is being recorded. And now I will introduce today's speakers. Liz Bletstein is a public finance attorney with extensive experience in conduit qualified private activity bond tax-exempt financing transactions. Liz's public finance experience includes serving as bond counsel, issuer counsel, and borrower counsel in a wide variety of tax-exempt transactions, with emphasis in transactions for 501c3 borrowers, such as hospitals, clinics, multi-member healthcare systems, senior living facilities, educational institutions, and cultural facilities, as well as serving as counsel to borrowers with post-issuance tax compliance matters and ongoing document compliance matters. David Brunori is a lawyer, journalist, author, and educator who specializes in tax and government issues. He is a nationally known state and local tax expert who regularly speaks before practitioners, revenue departments, and legislators. When he is not practicing law, he is a research professor at the Trachtenberg School of Public Policy and Public Administration at the George Washington University, where he teaches courses in state and local public finance and fiscal federalism. He also teaches state and local tax at the George Washington University Law School. In 2013 to 2014, he was a member of the District of Columbia Tax Revision Commission. David has published numerous books and articles on state and local tax policy, including his new book, State Tax Policy, a Primer. Tony Marino has an extremely broad-based financing practice. He has extensive experience representing lenders and borrowers in negotiating and documenting secured and unsecured financing transactions of all types and sizes, including single bank and syndicated commercial loans, asset-based financings, asset securitizations, equipment leasing, mezzanine debt financings, new market tax credit financings, construction loans, private placements, revenue bond credit enhancements, and direct purchases and workouts. We also have two guest speakers with us today. Michael Goodyear is a vice president of business banking at BMO Harris Bank. He has over 17 years of experience working with privately held businesses in southeast Wisconsin with revenues between 5 and 50 million. Michael prides himself on his ability to bring new ideas to the table and meets with clients on a quarterly basis to plan for future needs, improve banking processes, and minimize financing expenses. Russ Pleba is the regional commercial banking manager for Bank Mutual and is responsible for leading the commercial banking teams in both Green Bay and Eau Claire, Wisconsin. In addition, Russ continues his direct commercial banking activities with mid-market companies located throughout Wisconsin. Russ has over 20 years of experience financing growth companies, expansion projects, dividend recaps, and merger and acquisition deals. Now I will turn it over to our speakers.
Okay, I'm going to kick it off here today. I'm Tony Marino. Thank you everyone for joining us. So I'm going to lay a little bit of foundation, and then I'll turn it over to the to other people on the panel here. And so we're going to start off with just sort of describing what these transactions look like. So the first slide up here says IRB conduit structure, and the topic is titled Industrial Revenue Bonds. A lot of people now use the term IDB, which means industrial development bond. I use them sort of interchangeably. But I just want to, I think some of our speakers will use the other terms, so I just want to give you a little heads up. So, these start off when a company is looking to expand their manufacturing facilities, maybe buy some new equipment, add some jobs, and they work with the municipality. So I'll describe just sort of the structure generally and how these work, and then I'll turn it over to Liz, who will discuss some of the relevant requirements, how you qualify. There are a lot of rules, If you have to use the bathroom, that's the time to go. And don't get discouraged. I mean, these deals get done all the time. So there's rules, but we know how to make them work. And then our banker guests will discuss really why these are attractive, the benefits of these structures. So again, we have the company at the bottom. They're looking to expand the facility, or add some equipment, and they need to borrow some money. They work with the municipality in which they're located, generally a city, and then that municipality is going to actually issue debt. They issue bonds, the top little arrow there. And so we'll talk about who that might be on the next slide, someone buys those bonds. The debt obligations usually have 20 to 30-year maturities. They pay the purchase price to the municipality, who then lends that money to the company. So this is the conduit, right? The municipality is in the middle. They're just a conduit for the financing. Then the company, when they repay the loan to the municipality, it'll go back up through the structure. Usually it's direct to the bond trustee, but in theory, again, the municipality is just the conduit. And the important thing to know here is that, the municipality is not on the hook. I mean, they're issuing the bonds, the debt, they're borrowing the money from the bondholders, but they're not obligated on the bonds. It is a revenue bond, so only to the extent there's revenue that comes back from the company are they obligated to make payments on the bonds. So that's a quick overview of the structure. And that's the generic. Then we'll talk about three sort of specific structures and how this works. So the first one here is the bank purchase. This is the predominant method now that almost all of these are structured today. So if you look at, on the top right box there, the bond purchaser, that's simply the bank. So the bank purchases the bonds, pretty straightforward. Their commitment, however, is usually 5 to 10 years, and we talked about the maturity of the bonds being 20 to 30. So usually at the end of that 5 years or 10 years or whatever the initial term is, either the bank will say they're going to commit for another 5 or 10 years, or the company will go out and find another bank or someone else to purchase the bonds. And again, that's the predominant way that most of these are structured. The second way, and this used to be how we did them prior to 2008 for reasons I'll tell you about in a second. The bank wouldn't buy the bonds, other people would, but the bank would issue a letter of credit to support the bond. So if the company doesn't have money, they run in trouble, the purchasers don't care because they can draw on the letter of credit to get repaid. And that we have in brackets there's VRDO, that stands for variable rate demand obligation. That's how these were structured, where the investor then, because there's a letter of credit, all they care about is the credit of the letter of credit issuer. So they don't, I could issue the bond, or I could be borrowing from the municipality, or it could be Miller Coors, a much better credit than me, and the investor doesn't care because they're buying the credit of the bank, the letter of credit bank. That's what matters. So one of the reasons we don't do this anymore is in 2008, lots of banks were downgraded, and some investors didn't want to have credit exposure to a lot of banks. And so the DO, part of VRDO, is these are structured so that the institutional investor can put the bonds back. Basically, they can require them to be repurchased. There are other parties involved, which I won't really get into, but so a lot of the people did that. A lot of the holders of bonds did that in 2008, 2009, as banks were getting downgraded, and it led to a lot of problems. Again, here we have the letter of credit term is going to be shorter than the maturity of the bond. So again, you need, if you're the company, you need to work with the letter of credit issuer, your bank, to get it extended prior to maturity, or find a new bank to issue a new LC. And the last way that we see this done, and I'm don't see us a lot, but I'm working on one now. It's public offering. So, again, on this top right, the bond purchaser be like any number of people, but again, usually institutional investors, but there's an underwriter, they do a public sale. And these will be held to maturity. There's no put, what I put in quotes there. If you buy them, you are obligated to hold them to maturity. I mean, you can sell them, but the company doesn't have to buy them back. Typically, we see this as a fixed rate. I think that's the only sort of attractive reason here. Banks don't like to go fixed rate very long. I mean, you can enter into swaps and stuff, but again, you'll see up above the two prior examples, you do have some maturity risk if you're the company that you wouldn't have in this offering. More expensive, there's more people involved, but we are seeing it. So that lays a little bit of groundwork. I will turn it over now to Liz Bloodstein to go through the requirements.
Thanks, Tony. What Tony just described is what's known as a conduit bond structure, where a municipality issues a bond for a private enterprise. So now what I'm going to talk about and describe are the requirements for one type of conduit bond, which is the industrial revenue bond. And as Tony said, sometimes, IRB, IDB, we refer to them lots of different things. But I'm going to go through all the various requirements that must be met so that the industrial revenue bonds can be issued on a tax-exempt basis. And maybe this is a little basic, but what I'm referring to when I say that the bonds are going to be issued on a tax-exempt basis, I'm referring to the governmental bonds being issued in which the interest to the holder of the bond can be excluded from federal income tax. And the requirements I'm going to go through today are all of the federal tax requirements. Whether these bonds are also exempt from state tax or not depends on what state you're in. And it's going to vary from state to state. It's going to vary depending who it is that issues the particular industrial revenue bond. So what I'm going to talk about are really the federal tax law requirements for exemption from federal income tax. And it is a federal subsidy, obviously, by having the ability to issue tax-exempt bonds. By having the ability to issue tax-exempt bonds, you have the benefits of borrowing at a lower interest rate. Now, the bankers are going to go through probably more of the advantages, disadvantages, and how these deals are structured and the pricing that goes into pricing an IDB. But the lower interest rate, because the holder doesn't have to pay interest on their bonds, it's a benefit. So the federal government puts a lot of rules around that and puts a lot of restrictions on that, and over the years has tried to make it a little bit more complex and more difficult. But as Tony mentioned, we do these all the time, and so these are things that are still getting done, and we work through these various requirements. It's going to sound like a long list of very difficult requirements, but we'll get through them. This is kind of the stuff that us bond lawyers do regularly. And this is why we don't have a lot of good cocktail party stories. I'm going to go through a long list of federal tax code requirements. It's not going to be super, exciting. It's going to be a list of rules. When you look at the requirements for issuing a bond, you have to worry about both federal tax law as well as state law. I just went through saying I'm not going to talk about, state tax law at all, but you still need to have a governmental issuer or a municipality to issue the bonds. So you do have to go through an analysis in your particular state to determine who has the power and authority to issue the industrial revenue bonds for the purpose of your particular manufacturing project. And again, the process, procedure, and the requirements on how the bond transaction gets put together and documented and completed is mostly going to be driven by your state law requirements. But then you need to then go through all these federal tax law requirements to get the federal tax exemption on the bonds. I'm not very good at multitasking here. We keep using IRB, IDB, tax-exempt bonds, but what we're really referring to ever since the 1986 Tax Code Act is a type of private activity bond. And you're going to hear me say private activity bond a lot today when I go through all the rules. Private activity bonds, there's lots of types of private activity bonds, but it's generally when there's governmental bonds being issued for a private enterprise, and there's private activity bonds are 501c3 bonds, low to moderate income housing bonds, exempt facility bonds. But what we're talking about today is one category of private activity bonds, which are the qualified small issue bonds. And since there isn't sort of an easy way to always refer to qualified small issue bonds, we still refer to them as IDBs or IRBs. But what we're talking about from a tax code perspective is qualified small issue bonds. So I'm going to go through the qualified small issue bond requirements as well as requirements that are applicable to all types of private activity bonds. The specific rules for the small issue IDBs are focusing on the size of the issue as well as the use of the proceeds of the issue. There's sort of two main categories of requirements that both have to be looked at. In terms of the use of the proceeds of an IDB, the requirement is that 95% or more of the net proceeds of the bond issue must be used for the acquisition, construction, reconstruction, or improvement of land or depreciable property which meets the definition of a manufacturing facility. Breaking that down into sort of its component parts, the first component, the net bond proceeds, and the fact that at least 95% of your net bond proceeds need to be used for the qualifying expenditures. Net bond proceeds really just means the proceeds of the issue less any debt service reserve fund. Debt service reserve funds are much more common if we're doing a publicly offered issue of bonds. In the private placements, which are mostly what's getting done today, there's typically not a debt service reserve fund. So you're really talking about the total proceeds of the issue. 95% of it needs to be used for the qualifying expenditures. And we sort of refer to that as the good cost test, which leaves you 5% for bad cost. Your good math there is not good. I'm a tech clerk. The good costs are land or depreciable property. So it's really any of your expenditures that can be depreciated typically will qualify as a good cost. Bad costs, things that cannot be financed or that would have to count against the 5% limit, are things like working capital, financing of inventory, refinancing taxable debt. That's one of the things that's also limited and is not considered a good cost. Some of the things that get looked at when you start to look at a project for a particular client and what it is that they're looking to accomplish, things to analyze if you've got an acquisition situation, if there's goodwill as part of an acquisition price, whether that goodwill is a depreciable asset or not, and if it's based on how the transaction is structured, if it's depreciable, then it can be included and be considered part of the good cost. If it's not, then it wouldn't be eligible to be a good cost. Capitalized interest for a project, those things will typically be good if it's truly a capitalized interest that's going to be included in the cost basis of the project and depreciated. So you really just have to go through the list of what it is that's looking to be financed and determine what types of things would qualify your depreciable assets and be okay under the 95% test, and then which things have to count against the 5% bad cost. The other thing with respect to the 5% bad cost is you're already right out of the box. Any of your issuance expenses that are going to be paid for out of the proceeds of the bonds also count against your bad costs. And you're allowed to finance up to 2% of the issuance costs with the proceeds of the bonds. So you really only have about 3% that's really available for any of these ineligible costs that are included into the bad costs. And then the last component of the main definition is the manufacturing facility, which is really the key component here. We're doing financings for manufacturing. A manufacturing facility for this purpose has been defined to be any facility used in the manufacture or production of tangible personal property, including processing resulting in a change in the condition of the property. Based on letter rulings and the regulations and lore over the pronouncements by the IRS, the focus is really on whether there is some sort of transformation that's occurring in the process. So, I'll give a couple examples in the next slide, but the key is that you're really manufacturing something. You can also finance facilities that are directly related to the manufacturing facility, but those facilities, your ancillary facilities, are limited to 25% of the proceeds of the bond issue. And this is another area when you're sitting down with the client and you're figuring out what it is that is going to be part of the financing and would be eligible to be part of the bond financing. A lot goes into figuring out what is really part of the core manufacturing and what is sort of these ancillary and related activities that are going on that have to be limited to only 25% of your issue. The IRS is very stingy in its definition of what's going to count as part of the core manufacturing, and more things are starting to be included as part of these ancillary facilities. And things that we often spend time looking at and making a determination on are things like showrooms or some warehousing can sometimes be an issue. So you really have to look at those things that are directly related to the manufacturing and need to be part of the facility in which where the manufacturing is taking place, but is not directly producing the assets for the manufactured product. I'll give you some examples of where the IRS has been coming down on what constitutes manufacturing and what doesn't. One interesting thing, there was an example where, or a ruling where an ocean vessel that harvests and transforms scallops into a processed product ready for consumption was found to be manufacturing, but breeding, harvesting, and packaging fish was determined not to be manufacturing. And so I think, as I mentioned before, I think the distinction there is really focused on there being a transformation occurring in the process. Turning rolls of paper into paper bags, even a printing facility into books, those are things that will qualify as manufacturing. Other limits on the use of the bond proceeds relate to the timing of the use of the proceeds of the bonds. The general rule is that bond proceeds cannot be used to reimburse the borrower or your corporation for project costs paid prior to the date the bonds are issued. But then, of course, there's a few exceptions. One exception is if you've had the governmental issuer adopt a reimbursement resolution, sometimes referred to as the declaration of intent. And if you have, as part of your process with the municipality for doing the bond transaction, you have them do a resolution which meets all the requirements of a reimbursement resolution, and it sets forth the intent that a particular facility is intended to be financed with proceeds of a bond issue, then you can actually be reimbursed with the proceeds of the bonds back to the date of that resolution that was adopted by the municipality. So if you you use your own equity and you're spending your own money to start paying for a project, then you issue the bond. You want to be able to preserve the ability to take the bond proceeds and pay the company back for the equity that had already been contributed. So it's important to think about that early on. And if you're talking to clients, talking to people who are maybe have an upcoming project, to have them coordinate with the municipality and get these resolutions taken care of early on in the process so they don't lose the ability to finance some of the costs that they're incurring. Another exception are preliminary expenditures. Any preliminary expenditures, things like your architect, engineering, and planning costs, those things are eligible for reimbursement with proceeds of the bonds, even if they've occurred prior to the date the bonds were issued. One other tip has to do with acquisition of land. Land is not going to be considered a preliminary expenditure. What often happens sort of in the progression of a project is a company might go out and acquire a piece of land and then start thinking about how it is they're going to build their plant or build their facility, or what they're going to do with the, how it is they're going to move forward with building their new facility. The land itself is not going to be eligible to be even reimbursed with proceeds of the bonds unless the reimbursement resolution was adopted prior to the date of the land acquisition. So often we see there was a land acquisition, then a bunch of qualifying preliminary expenditures, and then the actual commencement of construction. So you just have to be careful and talk to clients before they actually acquire the land, so they don't get caught and not able to get paid back with the proceeds of the bonds. The other thing too to think about in terms of reimbursement is while there's rules that you can't reimburse yourself from proceeds of the bonds, they also don't want you to start paying for projects so early and wait so long to issue your bonds. There's actually an out date that the actual reimbursement with the proceeds of the bonds needs to be made no later than 18 months after the later of the date the expenditure was paid or the date the property is placed in service, but in no event later than 3 years after the expenditure was paid. So there's lots of just timing considerations and a little trap, you know, a few traps in there. So they're always looking to get you coming and going. So you just need to advise your clients to think about some of these timing considerations when they're looking at starting to finance a project.
Is there a 60 or 90-day look back on the inducement?
Yes, actually the federal tax rule is there is a 60-day look back from the date of inducement, but I forgot to mention that because in Wisconsin, actually one of the state law limitations is you are not allowed to reimburse at all back from the date of the preliminary resolution here in Wisconsin. That's the end date, so it sort of trumps the federal tax law requirement. But so that's just a Wisconsin limitation, but you're correct. Under federal tax law, you get a 60-day look back. Thank you. I always forget in Wisconsin we can't do that. Some other things that are limitations on the use of the proceeds of an IRB. There's just a prohibition that proceeds of a qualified IRB cannot be used to finance certain types of commercial, recreational, sports, and gambling facilities. No more than 25% of your bond proceeds can be applied to acquisition of land. There's also some limitations that relate to acquisition of existing property. If you're going to use proceeds to acquire existing facilities, then within 2 years of the date of the bond issue, you must perform qualifying rehabilitation expenditures, and you have to perform the qualifying rehabilitation expenditures within 2 years of the issue date, and the amount of rehab is 15% of the cost of the facilities financed by the bonds. So you sort of have a 15% rehabilitation requirement for any acquisition of existing property. And just to note, if the rehabilitation is not performed, interest on the bonds is taxable back to the date the bonds were issued. Since this is one of the requirements that we're really at the time of closing relying on the expectations of the client or the borrower to perform and use the proceeds in the way that they said they were going to spend them, the bond opinion that we're giving is sort of relying on those facts. So if you don't do what you said you were supposed to do and what was required by the tax code, then the bonds can become taxable if you don't actually complete the rehabilitation expenditures timely or in a significant enough amount. I've been keeping up here. My office slide, I don't even know. I can't see that far without the glasses thing. Oh, there we go. There we go. I'm caught up now. I started out by going through all the rules for industrial revenue bonds that deal with how you can use the proceeds, things that the proceeds must be used on and things that the proceeds can't be used on, and the various limitations surrounding sort of the tracing of the proceeds and where they can be applied. Now I'm going to focus on the size limitation and how big an IRB can be if you're going to issue the bond. There is a $1 million qualified small issue or a $10 million qualified small issue limitation. To be honest, we don't do a lot of the $1 million qualified IRBs. It's just a little small in terms of when you look at sort of the cost benefit analysis of some of the upfront time and costs that go into doing a bond issue. And the ability to sort of amortize, the bankers will talk about amortizing the costs over the term of the financing and things. So sometimes there's just not enough benefit there to warrant going through the process for doing a 1 million issue. So we most often are focusing on our 10 million issue small qualification. So in order to measure and make sure you qualify for the small issue limitation, you're going to be aggregating multiple things to make sure you fall within the $10 million limitation. The first thing you do is you look at the outstanding principal amount of prior tax-exempt bond issues within the same jurisdiction or municipality and that are financed for the same principal users or any related party to the principal users that are going to be applicable to this bond issue. And then you have to add to it certain capital expenditures by the principal user or any related party to the principal user during a 6-year test period. And then within that 6-year test period, you have to continue to measure to make sure that all of those things, the capital expenditures, the outstanding amount of the bonds that you've previously issued, plus your new issue, the bonds can't be issued by, okay, I should probably start over, but the bonds cannot be issued in an amount more than $10 million, but your capital expenditure limitation can go up to $20 million. I'll go through each of those components because I don't think I sort of explained that very well. But the rule for the $10 million limitation, you do need to make an election because it's just something that will be made on the books and records of the issuer. But the amount of bonds that can be issued will be offset by bonds that have already been issued in the same municipality for any principal user or related party to the principal user. And you have to sort of count that against your $10 million limitation, as well as add in any capital expenditures during a 6-year test period. But your capital expenditures can get you up to $20 million. So you sort of have an extra $10 million of capital expenditures that you're allowed to spend, but the amount of bonds are limited to $10 million. I'll go through each of those components and let you know what's involved. The $20 million capital expenditure test, you're looking at capital expenditures, whether or not they've been financed or not, during the 3-year period prior to the date the bonds are issued and the 3-year period after the date our bonds are issued. Capital expenditures of all persons who become principal users, I should catch up here, during the relevant test period get aggregated for the $20 million limit. And here the tax exemption is not lost until the date in which the $20 million limit is exceeded. I'm actually focusing an awful lot on how you sort of blow the qualification for tax exemption, but this is sort of, so you have, again here you have a monitoring duty to going forward. You're going to be looking at capital expenditures that have been made in the municipality for the prior 3 years, but you're basing on the date you issue the bonds, you're really relying on the borrower saying what they reasonably expect they have in additional capital expenditures over the next 3 years. So if they don't plan on having anything or any additional expenditures in the next 3 years, that's great. We're going to go ahead and issue the bonds on the closing date. But then something happens, a year or two, and the manufacturing facility gets built, it's up and running, and now they need to buy, significant more equipment to keep up with demand. And now all of a sudden they have to go out and buy a new, $10 million piece of equipment. If they buy that piece of equipment located in that facility, it could jeopardize the bonds that had already been issued for that facility if it would put them over the $20 million limit. Okay, thank you. We talked about the period of time in which we have to worry about capital expenditures. The principal user and what a definition of a principal user is. Principal user of facility is anyone who's a principal owner, principal lessee, principal output purchaser, or another principal user. Generally, that's interpreted and been defined to be anyone that uses as little as 10% of the space in the facilities. And you also have to worry about related parties to any of your principal users, since they're also going to get aggregated when you're determining the amount of tax-exempt bonds that you have to count towards your $10 million limit and the amount of capital expenditures that you have to count towards your $20 million limit. There is also, now that we've gotten through the $10 and $20 million limitation, there's also a size limitation in terms of bonds that can be issued that isn't limited to the jurisdiction in which you're issuing the bonds. It's actually anywhere that certain types of tax-exempt bonds have been issued for any test period beneficiary. You need to make sure that the time you issue the bonds, when you look at the test period beneficiary and all the related parties to the test period beneficiaries, you don't have more than $40 million in outstanding principal amount of bonds on the date of issue of the bonds. And again, that's just putting a, sort of a cap on related parties and how much benefit they can have in terms of tax-exempt bonds that they can have outstanding. So there are definitely some things that a borrower is going to need to keep track of and monitor. The use of the proceeds, tracking that at least 95% of the proceeds get used for qualifying good costs, and then also monitoring capital expenditures and for the period going forward, and anybody that would become a test period during the test period for the 40 million limit. So there is some ongoing requirements. Those were just the requirements for the qualified small issue IRB. As I mentioned, they are a type of private activity bond, and there's rules, additional rules that apply to all the private activity bonds. I'll just sort of list them for you. These are your public approval requirement. It's known as the TEFRA, sort of TEFRA hearing requirement, that before your bonds are issued, there had to have been a public hearing and an approval. There's a limitation on the maturity of the bonds. The average maturity of private activity bonds cannot exceed more than 120% of the weighted average economic life of the financed facilities. This is really the IRS's way of not enabling you to use long-term bonds to finance short-lived assets. We mentioned previously the limitation on land acquisition, the 25% limitation. We mentioned prohibition on acquisition of existing property, official action, cost of issuance, change in use penalties. They're obviously, if your bonds are outstanding for 30 years, there could be things that change after you've issued the bonds. And so there are certain remedial actions that can be taken if you do something that could potentially adversely affect the tax status of the bonds. But I note that violating the capital expenditure limit isn't one that you can cure once you've made a mistake. All private activity bonds are subject to state volume cap. So, oh, thank you. I'm flipping. State volume cap. Each state has a maximum amount of volume cap that they can allocate for different types of bonds. Generally, there's a whole set of rules relating to arbitrage and rebate. And in this interest rate environment, they have not been too difficult to satisfy right now. But basically, you need to spend the construction proceeds in 3 years, meet certain spend down requirements. No advance refundings are allowed, meaning you cannot, if you're going to use bond proceeds to pay off a prior bond issue, you have to do it within 90 days. Limitation on financing airplanes, skyboxes, health club facilities, gambling facilities, and liquor stores. And bonds will not be tax exempt while in the hands and owned by a substantial user. So basically somebody who sort of benefits and regularly uses from the finance facility, if they own the bonds in their hands, they will not be able to have the deduction, the federal tax deduction. Those are all the federal requirements for both qualified small issue and all the private activity bonds generally. I know I went through that quickly, but I think you'd probably be more interested in hearing about the pros, cons, and various structures that will be important to your clients when they're looking to possibly do an IDB. And I don't remember who gets to go next.
Russ is.
Okay, Russ, I'll kick it back to Russ.
First time we can say this,
Yeah.
we actually get to present the exciting stuff and being bankers.
Like I said, it's not cocktail party stuff.
We're skipping ahead a little bit for people on the web through the document.
Oh yeah, this was if we go through some more boring sort of the tax documentation.
But thank you, Liz and Tony and Quarles for having us here today. I feel like I'm in business law class again, and this is a mock trial.
Yeah.
And you're the jury, and there's some jury members here extremely experienced at bonds, and some that aren't. So I want to give you a business powerful case here. And the case I want to lay out is, since 2009, there hasn't been a lot of bond activity generally. There has been a lot of projects, and now we're starting to see projects come about. And I think people have forgotten about bonds. The world has also changed since 2009 that you used to do letter of credit bonds. Were very common for most of the bankers' room. You did letter of credit for IRBs. Typically, letter of credit today is only for large issues like a Marquette University, if they use that, if they don't have their own bond rating. So we're really talking about the case here is really about the bank purchase bond, which is on page 4 of your presentation here. So we're talking about flexibility, and I think people have forgotten because it's been so long since people have done bonds. Why do you want to do that? So what I want to lay out for you today is a case why, and then you as a jury at the end say, does that make sense? So one of the things I'd like to do is I like analogies for people who know me. And the analogy here is a personal finance analogy. So I always ask business owners when they're looking at a project, it's a personal finance question. If you have debt and you have a credit card, a home equity line, and a mortgage, if you have extra money left over at the end of the paycheck, do you pay something back if you want to reduce debt? And if so, why? And it's not a trick question. So everybody in their head kind of thinks, well, if I have a balance on my credit card, I'm going to pay that off first. And then after that, usually it's the home equity line or the mortgage. I'll ask, what's the rate? What's the rate I'm paying? So again, it's very quick, snap answers. And I always ask business owners, why do you finance your business differently? Typically, you'll have a credit card. It could be your acquisition debt. If there's a lot of M&A folks in the room, you could have higher price debt of some sort, seller paper, whatever. Then you'll have a home equity line, which is your revolving line of credit. Then you'll have what this was, in my analogy, is the bond or your long-term debt. Usually it's real estate or in some cases it can be equipment, but typically real estate. So I ask owners, why, if you personally finance a certain batting order with extra money, why do you do your business different? And they always struggle with the answer. And the answer is people don't know you can do that. So one of the things here from a business case, I'm going to be talking about general things. Mike's going to talk about specific examples, kind of trying to work this in tandem. So one of the thoughts is, think about when you look at your bond or you're looking at a project, there is flexibility. A bank purchase bond, which is what we're talking about, is essentially a term loan between the bank and the borrower that a fine bond counsel has put basically a tax treatment to. There should be no difference on that if you're working with someone that's experienced. There's a lot of experienced bond bankers in here today. Mike's another one of them. So think about how you build in that flexibility. So it really depends on the bank's underwriting criteria. But one of the things you can do, just as an idea, is the reallocation of principal from your bond, which is your mortgage. So let's say if you have, in my example, the mortgage debt, that's going to be your lowest cost of capital going back to your finance classes using the bond. So if you have extra money and the bank has all the other debt, the credit card, in my example, the home equity line, the mortgage, it actually makes sense to pay off the higher price debt early because then there'll be more money left over at the end of the year to pay back debt for next year. So it actually accelerates and actually pays down your debt faster. So think about that. And one of the things you can do is you can go interest only on real estate. For a bond, you can go up to, I believe, 39 years for IRS tax class for real estate. Most banks will only go 20-year amortization. What you can do is you can go interest only on some of that. Whatever you would pay on your principal on your mortgage, you pay it against your credit card. The bank still gets the same dollars in my example, but you're paying off the higher price debt, which is lowering interest expense and helps the borrower. So it's that principal reallocation, and we'll talk about a little bit. The other one too is if you're going to build a house, you're going to buy a house, you're going to have a construction period, and you can do that with a bond as well. It used to be with a letter of credit, you would dump all the proceeds into an account, you'd have money sitting there, and then you draw down, and there was an issue where you would have, it costs money to have that out there. With a bank purchase bond, you can draw as you go down and kind of build up that balance. So think about, if you're looking at a project, think about that construction element of it. The other case is the economics. A lot of people, think because interest rates are so low, it doesn't make sense. Why would I want to go through all this? It's a lot of time, a lot of effort. It costs a lot of money. And I always use the analogy, it's a payback period. It's a financial machine. If you talk to an owner who has a manufacturing facility and has a piece of equipment, they look at payback periods, 2 years, 3 years, they have some number in their head, and it's an automatic snap decision whether they buy the equipment. And it's the same way with the bond. So think about it. Right now, the average bank is doing about a 74% tax factor, give or take. It's 72. It just depends what bank you're at. And I say to anybody, if you have this project out there for whatever life you expect, if it's going to be out there 10 years, 5 years, 20 years, If you can get 26% off sticker and you got a Kohl's coupon for it, would you use it? Most people in the room say absolutely. In Wisconsin, we're frugal. So I think people have to look at the economics, and what we want to do is I'll kind of jump around a little bit. It all goes to what the interest rate environment is. So I'm going to skip ahead and then come back. When you look at interest rates today, I tried to put on here just a 1-month history going back about 30 years on 1-month LIBOR. And we're in that mode right now. Really, since 2009, it's almost nothing. Money is cheap. And this is just the base rate. Most companies went from prime-based to LIBOR-based type loans. So 1-month LIBOR is around 107 at the time I did this presentation. I try to put it out there because it's hard to see it on the chart. But you can see I got 2, 4, and 6. And you can see the multiples there. This is just your LIBOR base. If you just say an average commercial borrower, to make the numbers simple, is at a 2% or 200 basis point margin. If you're borrowing conventionally today, you'd be about 3.07. Pretty simple. And I think from an economics perspective, one of the things you have to look at is, okay, what does that mean to me? What's the powerful case? When you look at the current interest rate environment, the blue line here is the current forward interest rate look. So when you look on the graph, on the axis, you'll see that there's the interest rate, and then you'll see the years on the bottom. And when you look at the blue line, that's what the forward curve is. It's very, very flat. And what we did is we said, as a case, what is the red line and what is the green line? The red line and the green line are 5-year. If you did a 5-year swap today, just kind of a bullet, something simple, fix your interest rate. You're about a 187 today, just on the base rate. And then you're a little over 2 on a 10-year. So again, you could fix your cost of money for very, very cheap. So here's the interesting argument, and here's why it makes sense to do a bond. If you were to say the average borrower today borrows at LIBOR plus 200, and you can say to someone like Mike or Fred or someone in the audience here, I want to borrow money. Why would I want to do a bond? You say, just as a, maybe just a little survey here, how many people think today rates are going to be higher next year from where they are today? Just raise your hand. There's about 40 people in the room. It's almost 100%. So here's the argument. If you have a customer or an owner, if you're an attorney who's looking at a project that qualifies under these rules, if you say on a 10-year basis, and we'll use that one because the math is simple, it's roughly 2%. If you say it's 2% and they're borrowing at 2%, it's all in rates 4%. But using my 74% factor, I brought my rate down to roughly 3%. And today's variable rate that I just told you earlier is 3.07. So you could fix long-term 10-year rates on your real estate for the same rate that the variable is today. It is almost silly that you don't even consider it. There might be reasons why you don't. If you want to include some equipment or something like that, there's issues there. But if you think about it, if you could fix your project today, 10-year rate, roughly for the same price as the variable, but then the owners ask, well, that costs a lot of money. Liz is expensive. And I said, no, she's not. You got to do the math on it. So let's go back. So we go back and we look at back to what the numbers are. So if you say you save 1% for every, if you just look at the difference between, even if you want to do a variable rate, if you're not sure about it, it's about an 80 basis point spread using that 74% tax factor. It's about a 107 difference using a longer term rate. If you say for every $1 million that you borrow, you save $10,700 on a 10-year frame. If you do a $5 million issue, again, you're over nearly $54,000, $53,000. So if the cost of the bond is $50,000 and you're borrowing $5 million, you could pay it back, in my example, in less than 1 year. If it costs $100,000 to do a bond, you're borrowing $5 million, it pay back 2 years. So you just have to do the math on it to say, does it make sense? So it's really simple in this current environment to get payback periods under a year and 2 years, and depending on what you do and how big the project is. There are upfront costs. The bigger issues make it easier to get a quick one, but it's a very powerful argument on why you want to consider that. So I would just say, in closing, think about, if you have an owner who hasn't built a building or done anything in the last 10 years, tell them to look at bonds, talk to bond counsel, talk to their banker, talk to their accountant. Does it make sense? And with that, I'm going to turn over to Mike to go over some specifics.
So I get the part, I use the old politician trick here, and I get to drive it home with examples. I just got to place somebody in the audience for everybody can recall. So right out of the gate, I just want to kind of piggyback on what everybody else is saying up here on the panel. This is a huge economic development tool. It's just like anything else, the refundable tax credits, everything else, or training credits. It's all out there. Municipalities can use these. Use it as an example. I think the reason why we don't see a lot of bonds, I saw a lot last year and the following year, is lack of education and lack of bankers bringing this up, lack of attorneys bringing this up, lack of accountants bringing this up as a way to structure these types of deals. So I think it's all about education, and what we're doing right here obviously helps the cause. But we got a little bit into the weeds on the law part of this here. Obviously, a large part of our audience here is attorneys. In the end, if you have a developer who's looking to do a lease back to a manufacturer, call somebody on the council, on the board here, so call somebody that knows about bonds. If you're an economic development officer for a community, you're looking to attract people to come into your community to create jobs and build a building, call somebody. This could be a huge tool for them that puts them over the top and lets them come into your community, create jobs in your area. If you're a CPA and your client's going to build a building, talk. If he's going to buy equipment, any kind of capital expenditure, bring this up, because this is going to be a huge thing. Don't worry about all the qualifications, everything else. That's for Liz to do. She'll get an opinion out there that the bank and the borrower can rely on to make sure everything's kosher. The bank will structure a lot, what Russ was saying, we'll structure it accordingly to make sure it fits. So there's a manufacturer involved on a large cap expenditure need, equipment, building. Bring somebody else in, bring up these bonds. That's all I can ask. We have so much allocation in the state that goes unutilized every year. It's almost, how often does the government actually give you a tax break? I mean, come on, use this, guys. So like I said, I found it really hard to pick two examples here. I could have spent the whole time talking about examples of deals that we've done in the market here. There's so much flexibility that comes along with the IRBs. And other economic development type scenarios that can be brought in as well. So I'm just going to take it real quick. Again, what I'm putting in front of you guys here is illustrative only. Every bank has their own discount factor. Every bank has their own underwriting criteria. This is just deals that we've done, but every company is different. So there's my disclaimer. We got a local manufacturer that's experiencing some large growth, and he's having capacity issues. He's just outgrowing his building. He's got all his inventory out in the trailers in the back, and he wants to expand his building. He needs about 65,000 square feet. That's going to cost him about $3 million. He has an existing loan in the building of $500,000. He has that at 4% with a 10-year amortization. 10 years left to pay on that. The company, the building as complete is $5 million. I just put that there to illustrate that loan to value is in check with what most banks want, 80% loan to value. The company wants to preserve their cash. Obviously, they're growing. They can use their cash for better things than sticking it into a 20-year asset. They want to limit the impact of cash flow. They want to use their cash flow to grow the company and not to pay for, again, a 20-year asset. So the company also wants to take advantage of accelerated depreciation. So they're going to order a cost segregation study. For those that don't know what that is, somebody's going to go out there, they're going to look and say, okay, this asset can be depreciated over 10 years. This can be depreciated over 15. Within the bond, you can only take IRS standard straight line depreciation. So you can't accelerate. So if there's a cost segregation study that's done that says, hey, 500,000 of this project can be accelerated to a 7-10 years as opposed to a 39-year amortization schedule, that's a huge impact on taxes to the client. Therefore, we want them to take advantage of that. A lot of people that don't know IRBs well enough will say, well, you don't qualify for an IRB. You can't accelerate depreciation in an IRB. Wrong. We can take that portion that the cost seg says is able to be accelerated faster, where you can get the tax benefit, pull that out of the bond, put that conventional, and just finance the rest of it in the bond. So again, it's all about creative thinking. So in the end, the solution that we brought to the table here was we did, out of the $3 million needed for the expansion, $2.5 million of that we did on an IRB, and it qualified. We had it all double checked, and Liz wrote up a nice opinion that we can rely on. And we gave them the rate of 2.96%. Conventional rates at that point in time were 4%. That goes back to the discount factor. We're at a 26%, 0.26% discount factor. Some banks may be higher, lower, depending on their tax liability and the tax structure of the corporation. We did that over 10 years. Some banks will go 10, some won't. That's up to you. A 20-year amortization. So you notice you get over 1% reduction in rate. We took the $500,000 current line plus our current loan in the building plus the $500,000 that the cost seg study said, hey, you can depreciate this over 10 years and take huge tax benefits. We rolled that into $1 million note conventionally outside of the bond, so it wasn't any more longer. It didn't have to have accelerated. It could do accelerated depreciation. Didn't have to do straight line. We did that at 4 over 5 years, fully amortizing. If you notice up top, it originally was on a 10-year payback. This goes back to what Russ brought up. We took and reallocated principal. So obviously the 4% debt is a lot higher than the IRB rate of 2.96. IRB money is the cheapest money you're ever going to borrow. So preserve that if you can. Pay off the higher interest rate debt first, much like Russ's analogy. So we're actually going to reallocate, take all the principal that would go to pay down the bond, take that and apply that and front-end load the non-tax exempt debt at 4%. That customer just paid that thing off in 5 years versus 10 at a higher rate of 4%, saving a ton of money in interest. Not only does he get this, the customer get the savings on the rate between IRB and conventional of over 1%, also gets the advantage of paying off their debt faster by reallocating the principal. To turn the page, I just ruined my punchline. The benefit to the structure that we put in place is no cash injection. They're at 80% loan to value. We're fine. Customer can preserve his cash for growth like he wanted. Yeah, what's that?
Oh, you had the
I'm
same
sorry.
problem I did.
You want to work that for me?
Oh, yeah, I have to take the glasses off. There we go. Okay.
I can't see that either. The IRB rate was 1.04% lower than conventional, thus reducing the impact of cash flow. So now we're giving more cash flow back to the client to, again, fund growth, not fund a fixed asset. Overall, they saved $112,000 over a 10-year. That's just the IRB versus conventional rate. That's the difference between the IRB and conventional rate was $112,000. That's after I backed out the upfront costs, which would be the issuance fees. I think they're about $70,000 total. And after I assumed that for 5 years, the bond would be interest only. So that would be a lot higher number if we didn't have the reallocation. And we also avoided what's called a rate risk. Every 5 years, 3 years, 7 years, whatever the term is, this thing's going to reset. To Russ's point, as interest rates go up, 5 years from now, rates could be 9%. So with a 10-year rate locked in, you avoid that reset period every 3-5 years, whatever the term is. So the client can take advantage, lock in the lowest term rates for as long as possible. Kind of same concept as the rates were low on mortgages. You lock in the 30 years. It drove me nuts when I heard people doing ARMs. You get the lowest rates you're ever going to see. Lock that sucker in for 30 years. But people have their reasons. So by reallocating the bond payments, we were able to pay off the conventional higher interest rate debt 5 years versus 10 years. The savings there, just by paying it off quicker, was $123,000. So total, I have it bolded down there, total over 10 years, we saved $235,000 on this deal. And again, 10 million would be the highest we could go. A lot of these deals are between $2 and $8 million. Can't exceed 10 million. A lot of people ask, what's the minimum amount you're going to want to do on a bond? A lot of people say, well, if you have to make it has to be at least 2.5 million because that's what it takes in 1 year to make back your upfront cost to get it issued. I'd say in a low interest rate environment where rates are going to be higher, where I just gave you the example, in 5 years, it could be 9%. Take that interest rate hedge. If it's a 20-year asset, you're not going to want to pay off that debt faster. There's more than just a payback period involved. I would argue that if it takes you 3 years to pay back the issuance cost up front, you got a 20-year asset. You have that benefit 5, 6, 7 resets out down the road. So again, anything to do with manufacturing, anything to do with bonds, bring it up, get somebody involved here that can run the numbers. And on top of that, we were able to do the cost seg study, so we can pull that out of the bond. He was able to take advantage of the tax ramifications. I bolded it out down here real quick, guys. A lot of people also say that bonds are only for owner-occupied real estate. Incorrect. Developers can utilize bonds and do a lease back. They can build a 100,000 square foot building for a manufacturer. We can finance that with an IRB. It's investor owned at that point, as long as 95% of that facility is taken up by somebody doing a manufacturer and 75% of that is being utilized, right? So if it's half office space, half manufacturing, it wouldn't pass the rule. Bottom line, bring it up to developers, we can utilize that. You could even go to the point where it's a 100,000 square foot building, 50,000 square feet of that is going to be for a manufacturer, the other side's for an office space. We can finance just that 50% with the IRB and then do the rest conventional. So anytime there's a new building and manufacturer involved, get somebody involved. Last time I'll say that until the end. How are we looking on time here?
You can go. Yeah, we got a few minutes.
You got time? This is kind of this scenario here I like because we actually brought in other economic development type financing tools besides just the IRB. Again, IRB I think is the most advantageous one to use. Again, education is what's needed to get those going. Scenarios, we had a local manufacturer, again, outgrowing the current building that he was leasing. Company determined it would be cheaper to buy an existing building. So a lot of people will tell you, you can only build new buildings or add on to existing buildings with IRB funds. Not true. You can buy an existing shell of a building as long as you use 15% of the bond proceeds, go back into improving the 4 walls of that building. You can add on, retrofit, do whatever you want. So if they're out there shopping, they can't find any inventory that they can actually use. They have special needs that they need to retrofit. Find an existing shell of a building, buy it, do the bonds to improve on it, and just make sure Liz gives you the opinion that 15% is used for improvement to the existing building. So this customer went out and found a building. Total cost to purchase that existing building plus retrofit it to their needs was about $5 million. They had a current $4 million loan on their company's balance sheet that was for a buyout of a partner. That was sitting at 4.5%, and that had a 7-year amortization or payback. So that was kind of, I guess, stressing their balance sheet a little bit, which hurt them for the growth that they were looking to do. Company wanted limited impact to cash flow. They wanted limited impact to their cash in the bank to preserve that cash for growth, much like the other scenario. Company wants to pay down the operating company debt faster to improve the balance sheet, then they can borrow more and grow more. Company also like to take advantage again of accelerating the cost seg, but the cost segregation identifies that can be accelerated. So here's how we structured it. IRB purchase building and retrofit was $4 million. Again, 2.96. We gave a 10-year term. The rate would be a lot lower, probably under 2% if it was a 5-year term. 20-year AM. We went to Milwaukee Economic Development and said, hey guys, our customer doesn't want to part with his cash. He's bringing 200 new jobs to your area. Pony up $1 million and subordinate that to the bank. They were happy to do it. The tax incremental financing that they had in place and so forth and so on more than made up for them parking $1 million in this deal. Therefore, our client already had his equity into the deal through the MEDC. No cash came out. That cash can be used for growth. Existing operating debt, that's that $4 million. That was originally on a 7-year payback at 4%. We dropped the rate to 3.75. Took the proceeds, again, reallocated the bond proceeds to pay back this debt faster to the operating company. So at the end of 5 years, they'll have zero debt on the operating company's balance sheet, and then we start picking up and paying down the principal on the bond. So in the end, I know I'm going kind of quick on that. You can ask questions after, but in the end, so the benefits of the deal were no cash injection. MEDC picked that up. $210,000 in interest savings. $210,000 of interest savings. IRB versus conventional. That's again after the interest-only period plus the upfront cost. Still $210,000. That more than makes up for the $70,000 cost of issuance. We reduced the impact on cash flow because we have a lower debt service, right? There's less interest, there's a lower payment every month, and a lower interest rate that we get with the bond. Reduced future cash flow impact. So 10 years, they avoided the 5-year reset of the rate. So next thing you know, their debt service requirement or what they have to pay monthly goes up because their interest rates just doubled. Hypothetically, who knows, but could happen. So we reduced that. So we reduced the rate risk. We reallocated the IRB again. The IRB proceeds, we reallocated those principal payments and paid down that $4 million buyout note. And we got that paid off in 5 versus 7 years. That saved them $278,000. That was due to the shorter payback and the lower interest rate that we gave them. So that balance sheet's going to be nice and healthy here in 3 to 4 years to go ahead and continue to grow through bank debt if needed. Balance sheet, again, would be under 2 to 1 in 1 year. Talked about the reset. Total savings, $488,000 over the 10-year period, and met the 15% qualified rehab. We took the $750,000 was needed to go in. That's 15% of the total project. The MEDC was non-IRB money. That more than made up for that. So they were able to take the advantage of accelerating the depreciation. So again, lots of different ways to structure it. Everything's different. Everybody has their own core set of goals that they're looking to achieve. This is an economic development tool like any other. Use it, bring it up to people, educate as much as you can. It's being underutilized in our opinion. Educate your client or get them in front of somebody that can. And again, a lot of banks and companies don't have comfort around this. Therefore, they're going to give false, like you can't use this for an existing building. You can't use this if you're a developer. All false. So keep those two things in mind, and I think you'll do a service to your clients.
Should we pass it on? Dave, we'll leave this up to you to bring this home and talk about what's going on in the legislative world. Make sure we still have bonds to issue.
Hello, everybody. Can you hear me?
Yes.
Yes?
Yes.
Good. Good afternoon, everybody. It's an honor to be here and participate in this terrific session. I certainly learned a lot. And my part of this is going to be pretty short. There are proposals in both the House and the Senate that will significantly change the industrial revenue bond landscape. Obviously, if you work in this area, you should keep apprised of what is going on. I'm sure you will, and we can help you do that. The House and Senate bills are identical, and the House bill, which is referenced in the slide right there, it's actually H.R. 1115 if you follow such things. The Senate bill is Senate Bill 773. They're both called the Modernizing American Manufacturing Bonds Act of 2017, or MAMBA. And these are, of course, very pro-IRB bills. And basically, these bills, if enacted, will do the following. One, it's going to expand the definition of manufacturing facilities, something that our panelists talked about earlier, to include facilities that produce intangible products, software, patents, intellectual property. It's not quite precisely defined in the proposed bill, but it's going to include a lot more than the traditional manufacturing of tangible products. Second thing it's going to do, it's going to remove the functionality or functionally related and subordinate facilities restrictions. Elizabeth mentioned that the IRS is increasingly stingy in defining what is or isn't allowed to be funded. And what this removal will do is it will make the rules clearer and allow for a lot more activities to be funded and financed. Third, it's going to increase the manufacturing bond size limit from $10 million to $30 million. This, of course, is a very good idea since the limit has not changed since 1979, I think. So adjusted for inflation, you're just going to get it back to where you were 30 years ago, more or less. It is also finally going to increase the 6-year capital expenditure limitation from $20 million to, yes, $40 million. And this will obviously make it easier for manufacturers looking to expand. So these are all good things. If you're in the business, the big question is, will it pass? It did not pass last Congress. This same bill came up with the same sponsors in almost the same exact terms, and it did not pass last Congress. These bills have very strong bipartisan support, though. And if you look who the sponsors are, it's actually crazy bedfellows in there. Some very, very conservative Republicans, some very, very liberal Democrats. I don't know anyone, and I did a little research on this and talked to our contacts up on the Hill. I don't know anybody who opposes it. But it has not been scored. And so we don't know what the complete cost of this is. And that always makes people up on the Hill a little nervous. So that's a wild card. And then, as you probably know, there's a lot of other things going on in Capitol Hill these days. Like today, for instance. And so who knows if they're going to be able to get their attention on this particular bill. Right now, the sponsors think they can move these bills as part of a grander tax reform package. That's what their hope is, actually. They introduced them, but what they're hoping for is it's going to be all dovetailed into whatever tax reform comes out this year. And if there's no tax reform, they are very skeptical about whether these things will pass. That being said, though, you don't really know, right? No one really knows. But there's a lot of support for it, though. So that's just about it. And I'm going to turn it back over to our panelists because I don't know if we have time for questions or not, but I'm done. Goodbye.
Thanks, Dave.
We got to get Dave on the radio.
Yeah, and I apologize. We did go a little bit long, but if folks do have questions, we'd be happy to answer them. Oh, good. We got a question. You have to put your mic on. Yep.
One would be, we talked a little bit about that we amortize these things over 20, 25 years, but the life of a bond can be 120% of the assets. So if you have a bond that is very heavily real estate oriented, you can mature them out 40 years. That doesn't mean that a bank is going to allow that, but it gives you flexibility further down the pike. If your client's having either great growth or is having some financial problems, it gives you additional flexibility to possibly expand the bond, keep the benefit. And so that's just one thought.
Well, Rick, that's important as it comes to equipment as well, because the bond is set up on the industry useful life, which could be a 10-year if it's a stamping machine versus what the IRS considers to be the useful life. So at that point, you can also, if you banks have to agree to it, but you can also maybe go out 10 years to help the cash flow in an early state of a state.
I mean, really, most of the bonds have been real estate oriented because of accelerated depreciation.
True.
And the other, and Liz, you talked about the capital expenditure limitation, and just to keep it, because it sounded very onerous, if you're pushing your capital expenditures and there's 2 years left and you have to buy a machine, all you do is lease it.
Right.
And let the bank take the depreciation. So it sounded really onerous, and it's not.
Yeah, and I know I didn't do the greatest job walking through some of those specific requirements, but it's really something just at the beginning we talk through a worksheet. I know I made it sound probably a little bit more complicated than it is, but but
Just want to make
only time I ever ran into that cap expenditure 20 years, that 3-year look back and forth is with a tool and die shop that would actually own and maintain its own tool and die. So those would be assets on the balance sheet and capital expenditures. But I mean, if that gets raised to 40, I mean, everything's kind of geared for your smaller mid-sized manufacturer. So that's what a $10 million cap is. That's why I love what I just heard from Dave there, that they're going to look to raise the to 30 million and 40 million then on the cap look back. That'll open up the door to a lot of other clients to qualify for this.
Yeah, and usually if they have to incur and have additional equipment needs, usually it's a good thing. They're expanding, so you figure out a way to,
And the final caveat was just, we talked about developers, but developers who are active in municipalities have to be really cognizant of that capital expenditures limitation, because they can blow it. Really so that's the only caveat there.
Focusing on the related parties and the aggregation rules. But it can be done, but it's one of those things that you just got to pay attention to.
You're the word manufacturer, development, call it. She'll figure it out for you.